Hello everyone, welcome to this second and concluding video on taxation. The returns on debt funds are a result of two things, inflation and risk rewards. It is not right to tax an investor on inflation related returns. To avoid this, the concept of indexation has been introduced. Indexation is a method which is used to account for the rise in inflation between the year when the debt funds units were bought and the year when they were sold. The government declares a cost inflation index or CII values every year. The purchase price is inflated by multiplying with the corresponding CII value. This brings down the capital gains and hence the tax incidence. Let us understand indexation better with an example. Mr. X has invested 100 rupees in a debt fund in the financial year 2015-16 and he sold it for rupees 150 in the financial year 18-19. The CII in FY16 and 19 was 254 and 280 respectively. The indexed cost of acquisition will be 280 divided by 254 multiplied by 100, which is 110 rupees. In this case, the LTCG or the long-term capital gains will be 150 minus 110, which is 40. Since holding period is greater than 3 years, LTCG at the rate of 20% will be applicable. Tax payable will be 20% multiplied by 40, which is equal to 8. In the absence of indexation, the LTCG would be 150 minus 100, that is 50. And the tax payable would have been 20% multiplied by 50, which is equal to 10. Taxation in SIPs for equity funds. Till now, we have understood how tax is calculated for lump sum investments in equity, debt and balanced mutual funds. But huge investments in mutual funds come via the systematic investment route. It appears complicated, but actually it is not. Remember that each individual SIP is treated as a fresh investment. So, holding period is calculated separately and is taxed also separately. Let us assume that an SIP of 10,000 rupees is made in equity mutual fund schemes for 2 years. It will be considered as 24 separate investments of 10,000 rupees each. The last 12 investments will be considered as STCG or short-term capital gains. The first 12 investments will be considered as LTCG or long-term capital gains. The last 12 investments will be taxed at the rate of 15% flat. In the first 12 investments will be taxed at 10% without indexation in excess of 1 lakh rupees per year. The FIFO or the first in first out principle is followed here. It means when partial redemption happens, the purchase price will be considered of the first SIP. The same process will be followed for SWPs and other multiple investments. ELSS taxation. Investments in certain mutual fund schemes qualify for tax benefits. These schemes are labeled under ELSS or equity linked savings schemes and enable investors to avail of tax exemptions under section 80C. This is up to a maximum limit available under this section. Investments in ELSS schemes are locked for a period of 3 years. That is, withdrawal of money from these schemes is not allowed before completion of a time period of 3 years. In event of redemption after 3 years, long-term capital gains up to rupees 1 lakh are treated as tax-free. The LTCG in excess of 1 lakh is taxed at 10% without indexation. Securities Transaction Tax or STT. On the sale of equity or balanced mutual funds, an STT or Securities Transaction Tax of 0.001% is levied by the AMC. On the sale of debt mutual funds, STT is not levied by the AMC. Investors need not pay STT separately as it is deducted from the mutual fund returns. Dividend distribution tax or a DDT. Dividend distribution tax or DDT is a tax paid by AMCs when they declare dividends to unit holders. On equity mutual funds, the dividend distribution tax is 10% plus a surcharge of 12% and an cess of 4%, taking the total tax rate up to 11.64%. On debt mutual funds, the dividend distribution tax is 25% plus a surcharge of 12% and a cess of 4%, taking the total tax rate to 29.12%. DDT is deducted at source and only the net dividend after deducting the tax is paid to the investor by the asset management companies. Dividends are tax-free in the hands of the investor. That is, no further tax needs to be paid on them. With this, we conclude this video module on taxation in mutual funds. Thank you so much for watching the videos. Your support means a lot to us. Kindly watch both the videos to complete this module. We will then send you a course completion certificate. In case of any queries, you can get in touch with us. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.